You put $100,000 into a diversified index fund. You earn 4% a year. You never panic sell. You rebalance quarterly. You do everything right. In 20 years, you have $219,000. Adjusted for 3% inflation, that is $121,000 in today's money. 20 years of discipline for $21,000 in real purchasing power. That is the safe portfolio. That is what they sold you as the responsible choice. And nobody talks about how dangerous it actually is. Everyone calls this responsible investing. I call it a slow-motion loss that you have been trained not to notice. Let me break this down. $100,000 at 4% nominal return compounds to $219,000 over 20 years. Subtract 3% annual inflation, you are at $121,000 real. Subtract 0.5 to 1% in fund fees, the number gets even worse. The safe investor doubled their money on paper. But in actual purchasing power, they barely moved. Most people never run this math on their own portfolio. They see the nominal number and feel accomplished. They frame it as a win. The real number would make them uncomfortable. That is the whole problem. Now run the same $100,000 at 15% annual return with drawdowns along the way. Over 20 years, that compounds to $1.6 million. Even adjusted for 3% inflation, you are at $890,000. The gap between safe and aggressive is not 11%. It is $770,000 of real wealth over 20 years. That gap is a house. That gap is retirement at 50 versus retirement at 70. That gap is generational wealth you either build or you forfeit. And most people give it up because they never question what safe really costs. But what about the drawdowns? Here is the part nobody models. The 4% portfolio also has drawdowns. In 2008, the S&P dropped 56%. In 2020, it dropped 34%. In 2022, it dropped 27%. The safe index investor experienced those exact same drawdowns. They just got paid 4% a year for the privilege. The difference is not whether you experience drawdowns. It is whether you get adequately compensated for them. Stop thinking of volatility as risk. Think of it as the price of admission. You are paying that price either way. The question is not, can you handle a 50% drawdown? The question is, can you handle 20 years of 4% returns? One hurts for 6 months. The other costs you a decade of your life. One is visible. You see it on the screen, you feel it in your gut, and you can respond to it. The other is invisible. It compounds silently in the background while you pat yourself on the back for being responsible. The real risk is not volatility. The real risk is mediocrity that you never questioned. So where do I sit on this? I ran myself through the research frameworks honestly, not to confirm a bias, but to actually understand my own wiring. High sensation seeking on the Zuckerman scale. Bored by stability, energized by complexity. High tolerance for drawdowns. A 44% unrealized loss on Mara did not make me sell. It made me build an AI to manage the position better. Frustrated by normal returns. Not because I am greedy. Because the math of 4% over 20 years feels like accepting defeat. That is the honest profile. And the research has a name for this wiring. A study on financial professionals found that people who score high on psychopathic deviance personality scales, not psychopaths, but people who process risk differently, significantly outperform average investors in risk-adjusted returns over time. A separate study on hedge fund managers found that sensation-seeking traders who also have systematic discipline outperform both passive investors and reckless traders. The key word is also. Deviance alone fails. It blows up. Discipline alone is slow. It underperforms. The combination is the edge. Most people have neither trait. A few have one. Almost nobody has both. Nassim Taleb has a precise framework for this. Most investors are fragile. They need stability to profit, and volatility breaks them. Some are robust. They survive chaos but do not benefit from it. I am trying to be something different. Antifragile. I build systems that actually benefit from volatility. Higher VIX means fatter premiums on every option I sell. Bigger drawdowns mean cheaper entry points on every assignment. The wheel strategy does not need calm markets. It needs movement. Any direction. The chaos is not the problem. The chaos is the edge. That is the entire design. Here is what I actually do when the screen shows negative 44%. I do not sell. I do not add randomly. I check 3 things. Is the thesis broken? Is the position sized for survival? Is premium still paying? If all three are yes, I sell more premium and wait. If any answer is no, I cut and rotate. That is the entire decision tree. 3 questions, 2 outcomes. It is not bravery. It is not conviction. It is a checklist. And the checklist is what keeps me alive when normal investors are panicking. Here is the honest part. I know my own wiring. I know that my brain wants to oversize, wants to concentrate, wants to chase the asymmetric outcome. Left unchecked, that wiring blows up accounts. So I built an expected value engine and an AI discipline layer on top of it. Not to pick trades for me, to stop me from being the version of myself that oversized into 46,000 shares of one stock. The edge is the deviance. The survival is the system. One without the other fails. Both together is the entire thesis. Only about 2% of retail traders are consistently profitable over the long term. What separates them is not intelligence. It is not access to better information. It is not better charts or better tools. It is psychological tolerance for pain that normal people cannot sustain, combined with rules that prevent that tolerance from becoming recklessness. Most people quit after a 15% drawdown. The 2% have a system that lets them operate at 30 to 50% drawdowns without breaking discipline. That is the whole difference. Not smarter, just wired differently, with guardrails. So let me be direct. Am I extreme? Yes. I run a $642,000 portfolio concentrated in 2 names. I accept 30 to 50% drawdowns as a normal cost of doing business. I built an AI specifically to discipline my own impulses. I sell premium in the middle of a correction when everyone else is panicking and reducing exposure. Normal investors would call that reckless. I genuinely understand that. My response is simple. Run your inflation-adjusted 20-year projected return. Then tell me who is actually taking the bigger risk. The math will answer for me. Imagine a spectrum. One end is pure capital preservation. Treasuries, cash, CDs, low return, low volatility, and slow guaranteed underperformance. The other end is pure capital multiplication. Leveraged day trading, all in on single names, gamble level risk. Most investors sit near the preservation end. Reckless gamblers sit at the multiplication end. I sit in a specific zone between them. High conviction, high drawdown tolerance, systematically disciplined. The research says outperformance lives in that specific zone, not at the reckless end, which fails, not in the safe middle, which underperforms. In the narrow band where deviance meets discipline. Here is the challenge. Open a compound interest calculator. Put in your current portfolio value. Put in your actual annualized return, not what the fund manager told you, your actual after fees, after inflation return. Project it out 20 years. Look at the final number. If that number excites you, you are in the right strategy for your wiring. If that number makes you uncomfortable, if it is smaller than you wanted to admit, maybe you are more like me than you think. The math does not lie. You just have to be willing to read it honestly. I am not telling you to trade like me. I am telling you to stop pretending that safe is actually safe. The biggest risk in investing is not a 50% drawdown. It is 20 years of mediocre returns that you never questioned because everyone around you is doing the same thing. Normal is not safe. Normal is just slow. Subscribe to Mathematical Money if you want to see what the other path looks like in real numbers. Stop guessing. Start calculating. And if the math scares you, good. That means you are paying attention.